How do inverse ETFs actually work? Have you ever wondered how some investors seem to profit when markets decline? One way they do this is through inverse exchange-traded funds. So, how do these funds actually work? Inverse exchange-traded funds are designed to move in the opposite direction of a specific benchmark, like a stock market index. If the benchmark goes up, the inverse exchange-traded fund goes down. Conversely, if the benchmark declines, the inverse exchange-traded fund rises. This is made possible by using financial instruments called derivatives, which include futures contracts and swaps. These allow investors to make predictions about future asset prices. From a trading standpoint, inverse exchange-traded funds can be a smart alternative to traditional short selling. When you short sell, you sell a stock you do not own, hoping to buy it back at a lower price. This can be risky because if the price goes up, your losses can be unlimited. In contrast, with inverse exchange-traded funds, your potential loss is limited to the amount you invested. This makes them a more manageable option for many investors. Additionally, you can hold inverse exchange-traded funds in tax-advantaged accounts, such as individual retirement accounts, where short selling is not allowed. Now, let's talk about how inverse exchange-traded funds operate on a daily basis. They reset their positions each day to reflect the inverse performance of their benchmark. For instance, if an inverse exchange-traded fund tracks the inverse of the Standard & Poor's 500 index, it aims to decrease by 1% if the index increases by 1%. Likewise, it should increase by 1% if the index decreases by 1%. This daily reset means that inverse exchange-traded funds are best suited for short-term trading strategies. Over longer periods, their performance can differ significantly from the benchmark due to the effects of compounding. When it comes to trading volatility with options, understanding inverse exchange-traded funds can be beneficial. If you expect a market downturn, you might consider adding an inverse exchange-traded fund to your strategy to potentially profit from that decline. However, it is essential to be aware of the risks and costs involved with these funds. Fees can add up, and if the market moves against your expectations, you could face significant losses. In practical terms, inverse exchange-traded funds can be a useful tool for traders looking to protect their portfolios or speculate on market declines. They provide a way to gain exposure to the inverse performance of a market index without the need to short individual stocks. This can be especially helpful in volatile markets where traditional short selling may be more challenging or risky.